So this week, we are going to talk about liabilities. Liabilities related to businesses. One of the biggest liabilities we're going to talk about is payroll. Because when a company has payroll and you pay employees, there are liabilities that need to go to the various taxing authorities. There's liabilities for health insurance, for retirement plans, all kinds of things that really is a big focus on this chapter. So, what is a current liability? When a company or a bank extends credit, it's making a loan. The company or the bank is called the creditor, and the individual that's borrowing the money is either called the debtor or borrower. Long-term liabilities are those that are due in greater than a year. Current liabilities are those obligations that will be paid out with current assets over the next year. Now know that a long-term liability is due over a year, but the portion of that long-term liability that is due in the next year gets reclassified as a current liability. Accounts payable are those transactions that involve either purchasing goods or supplies on account that you generally have to pay out within 30 days. Accrued liabilities are the need for a company to pay current assets in the future. They're normally recorded at the end of the period as an adjustment. So, for example, an accrued liability, let's say the pay period just occurred, but employees worked 3 days at the end of the year, but they're not going to get paid that salary till the next year. That would be an accrued liability. Make sense? Or let's say we have a loan that we're not going to pay until the next year, but we've accrued some interest on that loan. That would be an accrued liability. Does that make sense, what I'm talking about? A short-term note payable would be a loan, basically, or a note that's issued to purchase merchandise or other assets. They can also be issued to creditors to satisfy an accounts payable. I think we talked about that. Let's say we have a customer that, that's an accounts receivable. Let's say we owe money, but we aren't able to pay it within the 30 days. A note, short-term note payable could basically be a new agreement we make with the person we purchased the supplies from in order to pay over a little longer period of time. Notes payable always involve interest, and usually it's a written document that spells out the agreement. Here it says, assume that Nature's Sunshine Company issued a 90-day 12% note for $1,000 dated August 1st to Murray Company for the $1,000 overdue amount. What we would do to record this note payable is we would debit the account payable that was on the books. We'll get rid of that accounts payable and we'll credit a notes payable. So we're basically removing the accounts payable piece and crediting the notes payable for $1,000. When the note matures, the entry to record the payment of the $1,000 plus the $30 interest will be, we debit the note payable when it is being paid off. We debit the interest expense and we credit our cash. Know that we keep the note payable, that liability, separate from any interest that has accrued, because the interest would be an expense. Okay? So depending if you're the borrower or if you're the creditor, depends how the transaction is going to be recorded. In this example, on May 1st, Bowden Company purchased merchandise on account from Coker Company for $10,000 net 30. The merchandise cost Coker $7,500. So if it's Bowden, if it's the person who's purchasing the goods, we would debit inventory and credit our payable. They're receiving the inventory, they owe the money. If it's Coker, if it's the one who's selling the goods, we would debit our accounts receivable and credit our sales. But then we also need to debit our cost of goods sold for the amount we sold. So it's no longer going to be an inventory. So we debit our cost of goods sold for $7,500 and credit our inventory. Now on May 31st, Bowden issued a 60-day 12% note for $10,000 to Coker Company on account. Basically, Bowden wasn't able to pay the bill, so he basically wants to extend it for 60 days with interest. So Bowden will remove the accounts payable by debiting accounts payable and crediting notes payable. And Coker will get rid of his accounts receivable, credit that accounts receivable, and debit a notes receivable. Does that make sense? Depending on which side you're on, how that transaction is going to be handled. When on July 30th, Bowden pays Coker the amount due plus 12% interest, what we have to do first is figure out how much interest. So if we take the $10,000 times 12%, that interest rate is always expressed in an annual percentage rate, times 60 divided by 360 days, or 1/6. The interest is $200. So we'll zero out the notes payable by debiting it. We'll debit the interest expense, and we'll credit the cash. That's for the person who's borrowing the money. For the person who's receiving the money, we'll debit our cash. We'll credit interest revenue. See, this is the other end of the side. The person that's lending the money, they're receiving interest revenue, and then we credit our notes receivable to zero out the notes receivable. Is that making sense, guys? A company may also borrow from a bank by issuing a note. Assume that on September 19th, Iceberg Company borrowed cash from First National Bank by issuing a 4,000 90-day 8% note to the bank. The entry would be a debit to cash, a credit to notes payable. Then, when the note is due, it's at that time you calculate the interest. In this case, it's an 8% interest, and it was over 90 days. So do you see, we take the loan amount of $4,000 times 8%, that $320 would be over the entire year. But since we're only doing 3 months out of 12, or 25%, 1/4 of the full amount. Do you see how we take that 320 and we divide it by 25%, or 1/4, to come up with how much is for 90 days? So we debit our notes payable to zero out what we owe. We debit interest expense because that's what we're paying on the loan. And we credit our cash for $4,080. Does that make sense, guys? Yes? In some cases, a discounted note may be issued rather than an interest-bearing note. A discounted note says the interest rate on the note is called the discount rate. The amount of interest on the note is computed by multiplying the discount rate times the face amount. The debtor receives the face amount of the note less the discount, and then the debtor must repay the whole face amount. So basically, instead of the note payable being what they owe and then we add the interest, it's kind of doing it backwards. So let's say on August 10th, Carrie issues a $20,000 90-day discounted note to Western National Bank. The discount rate is 9%, and the amount of the discount is $450. So you take the amount of the loan, the $20,000, the 9%, and since it's for 90 days, you take 25% of that. So what Carrie actually receives isn't the $20,000. It's the $19,550 less that discount amount. But technically that discount is interest, isn't it? It's what he has to pay to borrow the money. So in the case of discounted notes, we debit the cash that Carrie's receiving of $19,550. We debit interest expense for $450, and we credit our notes payable for $20,000. So in that case, the interest is reported up front, not in arrears. The entry when Carrie pays the discounted note is just a debit to notes payable and a credit for cash for the whole amount. The current portion of long-term debt, such as the current portion of installment notes, are shown on the balance sheet as a current liability. That amount that's due within the year. An installment obligate note is a debt that requires the borrower to make equal periodic payments to the lender for the term of the note. Usually, guys, installment notes are used for everything, such as buying a car, purchasing a home. You know, any type of long-term debt that is greater than a year, you generally pay off on a monthly basis. That's called an installment note. Let's look at this, guys. Angela's Hair Salon issues a $15,000 180-day discounted note to East Bay National Bank. The discount rate is 8%. Using a 360-day year, what amount of proceeds does Angela's Hair Salon receive for the note? What do you guys think that's going to be? You said C? This is the discounted, so they're going to receive less than the $15,000. 180 days, so it's half the year. Is it B? D. So it's D. You take the 15,000 times that 8% and divide it by 2. Got it? 15,000 times 8%, either divided by 2 or times 1/2. So $600 would be classified as the interest expense, and Angela's Hair Salon would receive the $14,400. Let's look at this one, guys. Bob Nebo sold 40,000 annual subscriptions of Bjorn for $60 during December 2025. These news subscribers will receive monthly issues beginning in January of 2026. In addition, the business had table income, I think it means taxable income, I'm sorry, of $920,000 during the first calendar quarter of 2026. Oh my gosh, I got to fix that. Just missed a couple words there for 2000. Okay, sorry about that. The federal tax rate is 30%. A quarterly tax payment will be made on April 12th, 2026. So we've got all kinds of things here, but what they want us to do is to prepare a current liability section in the balance sheet for Bob, not Von Nebo. So you can see we've got a couple things happening here. The subscriptions that were purchased, that he sold in 2025, 40,000 of $60 each is $240,000, right? But here, let me just 40,060 in December of 2025. The new subscribers will receive monthly issues beginning in January of 2026. In addition, the business had taxable income. Prepare the current liability section of the balance sheet for Bob as of March of 2026. So the subscriptions were $2,400,000, but they already sold or delivered 3 months of the subscriptions, right? So what's left are the remaining 9 months of the subscriptions, which is at the $1,800,000. So the reason that's a liability is they received the money, but they haven't provided the service yet or the product yet. So that is a liability until they provide that product. So you've got an advances on magazine subscriptions sitting of $1,800,000, and the federal income tax payable would be the $920,000 at 30%, or $276,000. So the total current liabilities, because those liabilities are due in the next 12 months, would be $2,076,000. Make sense? Yes? Here's exercise 10.2. Bennett Enterprises issues a $600,000 120-day 4% note to Spectrum Industries for merchandise inventory. we need to journalize the issuance of the note, the payment of the note, and then we'll go and journalize Spectrum's piece also. So it was a $600,000, 120-day, 4% note. For Bennett, we would debit our inventory and credit notes payable. Then, when we pay the note after the 4 months, we'll debit our notes payable to zero it out, debit our interest expense. We figure out the interest by the $600,000 times 4% divided by 3, or times 1/3, right? To give us the $8,000, and we credit our cash for the full amount. Is that making sense? On the other hand, Bennett would show a debit to notes receivable, a credit to sales, and when they received the cash, they would debit the cash, credit the notes payable, and credit interest revenue. Yes?
So we're just assuming that there's 360 days in the year?
That's how this book does it. Okay. Other books have always said 365. So again, that they're telling us assume 360. Okay. Yes?
In real world, would it be 365?
Yes.
Okay.
Because aren't there 365 days in a year?
Yeah. Something like divided by 3 point something or other.
Yeah. Yeah. Our February 29th. Yes.
And I'm assuming that changes on leap years.
I think we always just keep it at 365 days. I mean, you know, you make a good point. Yeah, because it isn't a day of interest. So, but generally for this class, they want us to do 360, so that's what we'll do. But in the real world, I always estimate 365. Bless you. A business issued a 90-day 6% note for $80,000 to a creditor on account. Journalize the entry to record the issuance of the note and the payment of the note. I'm going to let you attempt this and have someone help me explain it. Okay? Can y'all try this one? And when someone's ready, you guys can just let me know. Anyone want to help? Anyone? Yes.
I'm not exactly sure how to issue the note, but I can do B.
Okay, the issuance of the note. What happened? A business issued a 90-day 6% note for $80,000 to a creditor on account. So basically what that's trying to say is it had been an accounts payable, but it's now a notes payable.
Oh,
So it would be a debit to accounts payable and a credit to notes payable. Okay?
My question is, so it says A, the issuance of the note, and then B, the payment of the note at maturity.
Mhm.
So when we do like a debit to cash first,
So
then,
think of it like this. A business issued a 90-day 6% note for $80,000. It was to a creditor on account. So what that means to me, some of this is getting used to the lingo, the language, you know.
Yeah.
What that means is somebody owed this business $80,000, but they didn't pay it. So instead of holding to an accounts payable, they switched it to a note payable and got rid of the accounts payable. So there was no cash exchanged because they owed the money. They probably gave them merchandise in exchange for, and they owe them. Does that make sense? Okay, but you can do B. What's B?
so it's you debit notes payable, debit interest expense, and credit cash. It's the debit of notes payable is 80,000, and then the debit of interest expense is 1,200.
Perfect.
81 to 1.
Excellent. Does everyone understand how that works? In this scenario, a business had probably sold product and was waiting for 30 days to receive their money. The business couldn't pay it, and so they offered a note. So they debit the notes payable, the accounts payable, credit the note payable. It's basically wiping the accounts payable off the books and exchanging it for a notes payable. Then when the customer paid, you get rid of the note payable, you show the interest expense, and you credit the cash. Let's look at this one. On June 30th, Collins Management Company purchased land for, oh my gosh, I don't know how much. And a building for $560,000, paying $360,000 cash, and issuing a 5% note for the balance, secured by a mortgage on the property. The terms of the note provide for 20 semi-annual payments of $30,000 on the principal plus interest accrued from the date of the preceding payment. Journalize the entry to record the transaction on June 30th, the payment of the first installment on December 31st, and the payment of the second installment on the following June 30th. 20 semi-annual payments of $30,000. So that would be 30 times 41,200,000. So I'm assuming, okay, we'll see what, sorry, let me figure it out. So we have the land of 400,000. Let me get back here and make the land 400,000. Great. Okay, guys. So if that's the case,
slide two.
I'm sorry.
On the top, it says 0.
Thank you. So to record the purchase, we'll debit our building for $560,000. We'll debit our land for $400,000. We gave cash of $360,000, so we credit our cash, and the difference is our note payable, isn't it? Got it? Then when we made the first payment, so this transaction happened in June. So 6 months later, we made our first payment of paid down the note of $30,000. But don't we have to figure out what the interest is? So to figure out the interest, we're going to take our $600,000 note times the interest rate of 5% times half the year to figure out that would be interest of $15,000. So we debit our note payable of $30,000, debit our interest expense of $15,000, and we credit cash here of $45,000. Now the second payment, we have to remember that our note has been reduced by $30,000. So instead of having to pay interest on $600,000, aren't we now just paying interest on $570,000? $570,000 times our 5% times half a year. The interest expense will be $14,250. Does everyone understand that? PepsiCo reported the following information about its long-term debt in the notes to a recent financial statement. So it's showing the long-term debt, the amount in the current year for the long-term debt is $39,898. In the previous year, it was at $39,898, where the prior year was $43,728,000. And that current portion of that long-term debt that gets transferred over to a current liability, they show here in the prior year and the current period. How much of the long-term debt was disclosed as a current liability on the current year's December 31st balance sheet? Well, guys, we know it's the $3,872,000, don't we? Because it says that is the current portion of the long-term debt, right? How much did the total current liabilities change between the preceding year and the current year as a result of the current portion of the long-term debt? Well, if the previous year was showing $3,358,000, and here in the current year we're showing $3,872,000, didn't our current liability increase by the difference, the $514,000? Right? Okay. If PepsiCo did not issue additional long-term debt next year, what would be the total long-term debt on December 31st of the upcoming year? Well, wouldn't it be that net amount there, the $36 million? Okay, pretty straightforward. Now here's what I believe is one of the crux of this chapter: payroll liabilities. Payroll refers to the amount we pay employees for services they provide. Payroll and payroll taxes are a huge expense or cost of doing business, but they're necessary. You have to have payroll. Payroll is a little complicated in that you've got a lot of requirements in paying various people what they're due. Good employee morale requires payroll to be paid timely and accurately. So let's just learn some different definitions. Salary usually refers to the payment for managerial and admin services. It's expressed usually in a monthly figure. Wages usually refer to payments for manual labor. The rate of wages is normally stated on an hourly or on a weekly basis. So if you are hired as a salaried employee, it's a monthly amount. Wages are generally when you have an hourly wage. Does that make sense? How many of you guys have had either an hourly wage or a salary? You understand what I'm talking about, okay? The Fair Labor Standard Act, or can be called the Federal Wage and Hour Law, requires employees to pay a minimum rate of 1.5 times the regular rate for all hours worked in excess of 40 hours per week. However, if you're a salaried employee, you don't adhere to these rules. So when someone is a salaried worker, they can work 80 hours a week and they're only going to get paid their salary. But if you are a wage earner where you are hired by an hourly rate, anything you work over 40 hours for federal purposes, state has some different guidelines, but for federal purposes, anything over 40 hours, you need to get paid time and a half. John McGrath is a salesperson employed by McDermott. McGrath's regular rate is $34 per hour, and any hours worked in excess of 40 hours per week are paid at 1.5 times the regular rate. McGrath worked 42 hours for the week ended December 27th. So 40 hours will be paid at $34. 2 hours will be paid at 1.5 times his regular rate. 34 plus 16, $50? No, $51. So 2 of those hours is overtime, which equals $102. So his total pay for 42 hours would be the 40 hours at his regular rate plus the 2 hours at time and a half, which would be $14.62. Does everyone understand how we're coming up with that? The total earnings of an employee for a payroll period we call gross pay. From that gross pay, we deduct various items to come up with what his net pay is, or what we're going to give him in cash. Net pay is the amount that's actually paid the employee. Various things are going to be deducted from that gross pay to arrive at net pay. If he withholds federal income taxes or state income taxes, there's Social Security, there can be medical insurance, retirement plans, contributions if he chooses to have his employer pay various United Way on his behalf. So, employers normally withhold a portion of employee earnings for payment of the employee's federal income tax. Each employee authorizes the amount to be withheld by completing a Form W-4. How many of you guys have filled out a W-4 before, where it gives your name, your Social Security, your address, and the amount of allowances? They've changed recently. It's supposedly easier, but that's debatable. On the W-4, an employee can indicate if he's married or single, number of dependents, if he has another job, other things. But basically speaking, it's a form that you let your employer know how your scenario so they know how much to withhold. Okay? Employers are required to pay Federal Insurance Contributions Act, or known as by the Federal Insurance Contribution Act, called FICA, to withhold a portion of earnings from each employee. The FICA tax goes to two programs. One is Social Security and one is Medicare. So 6.2% goes into Social Security, which is what is used to pay those retirees their monthly amount. And a certain amount, 1.45%, 1.4, goes into what's Medicare, which provides health insurance for the senior citizens. The amount withheld from each employee is based on the employee's earnings paid in the calendar year. The withholding tax rates and maximum earnings subject to tax get revised by Congress. So basically this FICA tax, the Medicare goes on forever and ever, amen. So it doesn't, if you make $600,000 a year, you have to pay Medicare on all of it, the 1.45%. The Social Security, the 6.2%, has a cap each year. I think right now it's at like $165,000. It goes up every year. So if an employee makes $500,000, the first $165,000 of Social Security gets taxed, but the entire 1.45% is taxed for whatever the employee makes. So let's assume this. Let's assume Social Security is a 6% rate, and just to keep it simple, we've got Medicare to be a 1.5% rate. And in this scenario, Social Security and Medicare are taxed on all earnings. John McGrath's earnings for the week ending December 27th are $1,462. So that means that the FICA, the 7.5 amount of $109.65 needs to be taken out of his paycheck, but it's broken down by Social Security of 6% and the Medicare tax of 1.5%. So the $109.65 is taken out of his check, broken down into two components. Employees can choose to have other amounts deducted. They could have retirement, life insurance, disability payments, all kinds of things. Or if you're a part of a union, that union's going to withhold their fees, those union dues, from the paycheck also. So in this case, we're going to assume John authorizes weekly deductions of $20 to go into his retirement savings and $5 to go into a United fund, $257.95 of federal income taxes withheld. So after we take into account all of these deductions from his gross pay, the net pay, the amount that's going to be put into his checking account, is $1,069.40. Does that make sense, guys? Yes? Employers also have to pay various payroll taxes. Employers have to match the employee's FICA tax. There's also a federal unemployment compensation tax we call FUTA, where employers have to pay into the federal unemployment a certain amount. And what's more significant, state has unemployment taxes because that's primarily where, if you were to receive unemployment, you receive it through the state. So the employers also have to pay some state unemployment. So the employee, we know, gets federal taxes withheld, state taxes, Social Security, and whatever other items they deem that are voluntary. The employer has to match what the employee gets taken out of his check for FICA taxes. The employer has to match it. And then along with that, they're required to pay federal unemployment and state unemployment. So, to record for payroll at the end of the period, the following information for McDermott Supply is shown here. The salaries for the sales is $20,000, office salaries $5,000, for total payroll of $25,000. So $25,000 is subject to Social Security and Medicare, which we're going to call FICA, and only $10,000 of that money is required to be paid into state and federal unemployment. So it tells us that the Social Security tax is 6%, the Medicare is 1.5%, the state unemployment tax is 5.4%, the federal unemployment rate is 0.08%, and then it gives us all the employee withholdings. Okay? Remember that state and federal unemployment is only the employers to pay. The employee will never pay that. Okay? So, to record the payroll, the journal entries for what the pay period ending, we would debit the total sales salaries expense. We would debit the office salary expense. We would credit that Social Security tax payable out of the employee's paychecks. We would debit the Medicare out of the employee's paychecks. Credit. We'd credit the employee's federal income taxes payable, the employee's state income taxes payable, the retirement contributions payable, the charitable contributions payable, and what's left over is going to go into salaries payable. That net pay is going to be salaries payable. Okay? So we would debit the expenses and credit all the payables. So our salaries expense, that total is going to equal all of our payables total. Since employers have to match the employee's Social Security and Medicare tax and then pay the federal and state unemployment tax, for this payroll, the employer's payroll taxes are $2,495. So we need to do another journal entry to show the payroll tax expense for the employer of $2,495, and all of our credits are payables. The Social Security payable, tax payable, the Medicare tax payable, the state unemployment tax payable, and the federal unemployment tax payable. Yes?
What would it look like if you threw in like a 401k and like a match?
It would just be another payable. So basically, if it would still be a payroll tax expense, but it would show, and basically it actually would be, it would be a portion of their salary.
Yeah, because it takes.
It's a portion of the salary. So the employee would have a deduction. It would be a deduction from his gross pay, and depending on how if the employer chooses to pay some, it's basically a piece of the salary,
Yep.
that the employer is choosing to pay. So all of these payables, though, are shown because they need to go to the various respective businesses. Companies pay employees either by electronic funds transfer or by issuing payroll checks. With electronic funds transfer, the employee's net pay is deposited into their bank account for each period. And then the employees receive a statement that shows how the net pay was computed. Most companies use a special payroll bank account for payroll because it just can be a whole accounting system on its own. How many of you guys receive your payroll in your bank account versus checks? How many in the bank account? How many checks? Really? Okay. Is a smaller company?
I have two jobs. One's one I get checks for now. It's this upcoming company, and then another one I've just been at for 2 years.
Yeah.
I get direct deposit.
Usually direct deposit is just easier and it's faster. Internal controls for payroll. Basically, the person who decides how the pay is going to be handled is usually the manager, that determines how the hours of the division, and usually a separate department handles all payroll. Which of the following taxes is paid by both the employee and the employer in the payroll process?
State and federal employee tax.
Try again. Who said C? FICA. Remember, the Social Security and the Medicare is paid. The employee takes it out of his check, and the employer must match the exact same amount. State unemployment and federal unemployment is only paid by who? The employer.
You said the employer, but I swear in the past I've paid into unemployment.
You've paid into state income taxes, but you never pay into state unemployment. It's only the employer.
Okay.
Because think about it, the employer has hired you, and in the event they let you go, they're required to pay this expense for if that would happen, you've got a benefit. Sometimes if they overpay you, they might request it back. That happens a lot. Say you were paid more than you should have been paid, and then they'll request it back from you. An employee earns $25 per hour and 1.5 times that rate for all hours in excess of 40 hours. If the employee worked 52 hours during the week, determine the employee's gross pay and net pay for the week. Assume the Social Security tax rate is 6%, Medicare is 1.5%, and the employee's federal income taxes withheld is $225. So 52 hours, we would show 40 hours at the $25 an hour. We would show 12 hours at 1.5 times that rate. 25 plus 1250. So 3750. 12 hours, that'd be 450. The gross pay, 1450. We take away the Social Security, the Medicare, the federal withholding that they told us. So all those deductions are $333.75. So the net pay would be the $1,450 minus the $333.75. Does that make sense, guys? Yep. K Mello has 3 employees, a consultant, a computer programmer, and an administrator. The following payroll information is available for each employee. So we've got regular earnings rates for the 3 employees, the overtime earning rates. So you can see the consultant doesn't have an overtime rate. He's paid on a salary. The 2 hourly workers have different overtime rates. And we also see the federal income taxes that are going to be withheld. It tells us for the current period, the computer programmer worked 46 hours, the administrator worked 50 hours. The Social Security rate is 6%, Medicare is 1.5%. Determine the gross and net pay for each employee. So the consultant has the flat $6,000. We take the federal income tax away from his check. We calculate the Social Security of $6,000 times 6%. We calculate the Medicare $6,000 times 1.5%. For the computer programmer, we have to calculate the first 40 hours are flat. The extra time, I think, was at double time, at 2 times the hourly rate, $55 per hour. So anything over the 40 hours, he gets paid 2 times the base pay. You get his total. They told us what the federal withholding would be. We have to calculate the Social Security and Medicare just like we did the other employee. And we come up with his net pay. And then the same is true with the administrator. We have to take his hours over 40 hours times 1.5 times the rate to calculate his overtime earnings. And then from there, figure out his Social Security and Medicare. The point of these exercises are to understand all of the different items that are deducted from the pay that need to be paid to other agencies in order to compute net pay. In the following summary of data, some amounts have been intentionally omitted. For the current pay period, the computer programmer worked 46 hours and the administrator worked 50 hours. Assume that the Social Security tax rate was 6% and the Medicare was 1.5%. Determine the amounts omitted, journalize the entries, and journalize the entry to record the payment of payroll. So basically, they're letting us know various items, and there are certain things that are missing. So basically, I'm just going to kind of go at it this way. The net amount paid ultimately here is the $338,850. They gave us that number. The total deductions we showed to be $201,000. We were missing the union dues. But we can plug in the union dues when we basically know what our earnings are. We know what our overtime pay is. We know what our regular pay is. We take into account all the deductions. And we basically, what we're trying to show you is you can plug in what the union dues are when you know all the other variables. To create the journal entry, we would debit the factory wage expense, the sales salary expense, and the office salaries expense. We would credit all of our payables, what we need to pay: Social Security tax payable, Medicare tax payable, employee income tax payable, medical insurance payable, union dues, and then ultimately that salaries payable is what the net pay is. And then when that salaries payable is paid, we debit our salaries payable and we credit our cash. Make sense, guys? Okay. Big Howie's Hot Dog Stand is a fast food restaurant specializing in hot dogs and hamburgers. The store employs 8 full-time and 12 part-time workers. The store's weekly payroll averages, oh boy, I think that means $5,000 for all 20 workers. For all 20 workers. Big Howie uses a personal computer to assist in preparing paychecks. Each week, the store's accountant collects employee time cards and enters the hours worked into the payroll program. The payroll program computes each employee's pay and prints a paycheck. The accountant uses a check signing machine that signs the paychecks, and the restaurant owner authorizes the transfer of the funds from the regular account to the payroll account. For the week of May 12th, the accountant accidentally recorded 100 hours worked instead of 40 hours worked for one of the full-time employees. They wouldn't want me doing the payroll with these mistakes. Okay. Does Big Howie's Hot Dog Stand have internal controls in place to catch the error? If so, how will this error be detected? So instead of paying one guy 40 hours, they paid him 100 hours. So obviously they have an internal process that is lacking because that error should have been detected. Before funds are transferred from the regular bank account to the payroll, the owner authorizes the total amount. He should catch that error, since the extra 60 hours would cause the weekly payroll to be substantially higher than usual. I know in my office, when I do the payroll, the software knows what roughly each employee earns, roughly, as far as how many hours they work every 2 weeks. And so if anything's off, it usually flags me. Many companies provide extra benefits to employees apart from just their salary. Fringe benefits could include vacation, medical, dental, and retirement benefits. The cost of employee fringe benefits is recorded as an expense by the employer. Most employers provide vacation. The liability to pay for employee vacation should be accrued as a liability at the end of the year. So assume the employee earns 1 day of vacation for each month worked. The estimated vacation pay for the year ending December 31st is $325,000. The employer shows a debit to vacation pay expense, because we're recording this expense in the period in which the workers worked to earn that, and we credit our vacation pay payable to show the accrued vacation pay during the year. Sometimes employees have to take their vacation within a year. Sometimes employees are paid off on their vacation. How many of you guys have been paid for your vacation instead of taking it? Yeah. If employees are allowed to accumulate their vacation pay, the estimated vacation pay payable will not be taken within the year, then that ends up being switched from a current liability to a long-term liability. Now, guys, pensions don't happen as much anymore. Pensions were big 30, 40 years ago, but it's mainly been shifted to a retirement plan. Pension rights are accrued by employees as they work based on the employee's pension plan. There can be two kinds, the defined contribution and defined benefit plans. In a defined contribution plan, the company invests contributions on behalf of the employee during the employee's working years, and both employees and employers contribute to the plan. The 401k plan, I guess they're calling that a pension plan, which basically is invested throughout the life. Under the 401k plan, employees contribute a portion of their gross pay into an investment. The benefit of these 401k plans is that 401k, that those amounts contributed are deducted from gross pay, so they don't have to pay income taxes on that 401k if it's not a Roth 401k. Sorry, it starts getting complicated because they have so many different changes. They're not taxed usually unless you withdraw them. So the taxes are deferred until you choose to take them out come retirement. Assume that Heaven Scent Perfumes contributes 10% of employee monthly salaries to an employee 401k plan. Assuming $500,000 of monthly salaries, the journal entry to record the monthly contribution shows as a debit to pension expense and a credit to cash. In this case, the company is paying a benefit that's going into the form of a pension to the employees. In a defined benefit plan, the company pays the employee a fixed annual pension based on a formula. I guess these defined benefit plans is what I mean have gone away. The formula is normally based on a couple factors, but in the defined benefit plan, the employer is obligated to pay the fund the employee's future pension benefit. The pension cost is treated as a pension expense, and cash is then credited by the employer for the amount that they are funding it. This type of plan is common within the government sector, but not as common anymore in the public sector or in the normal corporations. Assume that the defined benefit plan of Hinkle Company requires an annual pension cost of $80,000. This annual contribution is based on estimates of Hinkle's future pension liabilities. On December 31st, Hinkle pays $60,000 to the pension fund. To record the payment, we'll debit the pension expense, we'll credit the cash, and we'll credit the unfunded pension liability, that amount that still needs to be funded. Post-retirement benefits. Once an employee has retired, depending on what their package is, sometimes those retirees can still get various medical care, life insurance, various types of benefits through their employer. let's look at this one. In a recent year's financial statements, Procter & Gamble showed an unfunded pension liability of $5,428 million and a periodic pension cost of $340 million. What's that mean? Well, the $5,428 million unfunded pension liabilities, the amount of the pension obligation that is greater than what the assets are in the plan. Procter & Gamble has underfunded its plan relative to the obligation. This can occur when the company contributes less to the plan than what they really should be contributing. The $340 million periodic pension cost is a measure of the amount of pensions earned by employees during the year. So again, these are all estimates based on how long they think they're going to be paying their employees. So you see payroll's a big thing, just like, in your homework. That's going to be primarily what you're doing. Installment notes, remember, are an amount that's being paid over a periodic time. Equal periodic payments, usually they happen on a monthly case. Each note payment includes paying down a piece of the principal and paying the interest. At the end of the note's term, the principal would be paid in full. So when an installment note is issued, we're going to record a debit to cash, a credit to the payable. So assume Lewis Company issues the following note to Citibank. We've got a $24,000 note. The interest rate is 6% over 5 years, and we have a payment. So these are annual notes here. This is paying it once a year. The payment is $5,698. So the initial note, we debit our cash and credit our notes payable. And then each payment, each year, that payment of $5,698, a portion of that will go for interest and a portion will go to pay down the principal. So you see, the note started at $24,000. But if we're paying 6% interest each year, the first year that interest rate is $1,440. So the amount of the note, the $5,698 minus the interest, that difference decreases the note, that amount payable. So after year one, the note started at $24,000. Since we're paying down $4,258 of that note, at the end of year one, our new note balance is $19,742. So I just want you to understand how we calculate that is the amount we're paying in the note. We calculate what the interest is we owe. We subtract that interest from the note payment to come up with how much of that payment goes towards principal. So then in year two, we are only paying interest on the carrying amount of the note, which is now $19,742. At the end of year two, when we make the payment, our interest is based on the new balance of $19,742 times our 6% interest rate, which then will bring down the note. The new carrying balance will be the $19,742 minus what we're paying down in principal of $4,513, gives our new balance on the note $15,229. As you see, by year 5, do you see how it's perfect? And we had a balance of $53.74. When we figure out the interest on that balance and we offset our payment from the interest, we've paid off the note and we're now at 0. That is an installment agreement. And this is called an amortization schedule that shows how much is getting paid off and the allotment between interest and principal each period. So to record the first payment, we would debit our interest expense for that amount for the year, debit our notes payable to help reduce that principal balance, and credit our cash. We do the same for every year, and you see in year 5, when we debit our interest expense, debit our note payable, you'll see now there's no liability left. We're at 0. We don't owe any note payable anymore. The final payment, the carrying amount of the note, is 0. So guys, let's look at this one. Based on the allocation of periodic payments for an installment note, over time, the payments will contain, what is it? It's going to be interest is going to be higher in those early years because the principal balance is higher. And then as we pay off the principal balance, the interest will become less. I'm going to do one of these and then we're going to move on because I don't want to get myself too far behind. On the first day of the fiscal year, Schiller borrowed $85,000 by giving a 7-year 7% installment note to a bank. The note requires annual payments of $15,772, with the first payment occurring on the last day of the fiscal year. The first payment consists of interest of $5,950 and principal of $9,822. So to record the installment or the initial taking out the loan, we debit our cash and credit our payable. Then it tells us what our interest is and how much is going to the principal. We debit our interest expense. We debit that note payable, that amount we're paying against the principal to bring it down, and we credit our cash. Explain how the notes payable would be reported on the balance sheet. Well, the current payment would be a current liability. The amount that's due not in this year would be classified as a long-term liability, or in this case, they call it non-current liability. There's a lot more of these, but I just want to move on so I don't get ourselves behind because I've got one more piece to take care of. So please make sure you look at some of these exercises so you know how they work. Here's what I want to talk about. Something called contingent liabilities. An example of a contingent liability is a warranty. How many of you have purchased a warranty when you have purchased an electronic, like a cell phone? That is a contingent liability for a company. Why is that? Some liabilities may arise from past transactions only if certain events occur in the future. These are called contingent liabilities. Here's what needs to be measured. The likelihood of it occurring, and the measurement, meaning the likelihood of occurring is classified as probable, reasonably possible, or remote, and the ability to measure the potential liability is classified as estimable or not estimable. So if a contingent liability is probable and we can reasonably estimate the liability, we are going to treat it as a contingent liability on the books. The best example I can tell you is my husband and I, 10 years ago, bought an RV. We had a 5-year warranty on our RV. I mean, it was pretty darn good. But over those 5 years, they probably had to replace different items, send us a new propane deal, had to replace our shower, had to fix our door. I mean, there were various items. And for this company, it's probable they're going to have to fix some things, right? And they probably, based on past history, can estimate what they're going to have to fix. So they would report these contingent liabilities in their financial statements. Now, if a contingent liability is probable and the amount can be reasonably estimated, we are going to report it. So, assume that during June, a company sold a product for $60,000 that includes a 36-month warranty for repairs. The average cost of repairs over the warranty period is estimated at 5% of the sales price. So to record this warranty in the year of sale, we're going to debit our product warranty expense for a percent they estimate, and they credit product warranty payable. So the product warranty expense is going to be an expense in the year of the sale, because we know we match our revenues with the expenses our expenses with the revenues they help to generate. And we show that as a payable. So when in future years we do have a need to fix things, we offset that liability. If a product is repaired under warranty, the repair costs are recorded by debiting the product warranty payable and crediting cash. So if a $200 part is replaced under the warranty on August 16th, we'll debit the product warranty payable for $200 and credit our cash. See, since the expense happened in the period in which the sale happened, when in future years we need to fix something, we just debit that liability. Okay? A contingent liability may be probable but cannot be estimated. In this case, the contingent liability is disclosed in the notes to the financial statement, and that's all we do. Yes?
Is an insurance company like receiving payments for insurance? Is that contingent liability?
No, that is the reason they're doing business. So in that scenario, the reason the insurance company is in business, they receive their premiums as revenue and they have various expenses. So in that case, my guess says no. Think of the oil spill. Because think about it, the insurance, they're in business for the what if claims. Yeah. And so that is a cost of them doing business. This is for the uncertainties. This is the oil spill. Now, they wouldn't have even known about that oil spill. That wouldn't have even been on their books, because how could they have even assumed that? These are items that generally the best example of contingencies are warranties, where you know it's going to happen. You know, because of past history, they know things are going to break down. Now, I know with most items, they have a certain amount of a warranty that's just given against a product. But oftentimes we can buy extended warranties, which we're paying for that too. But I generally, on my iPhone, I do buy the extended warranty, because guess what? For me, the chances are very likely that I'm going to do something stupid. because it's on me all the time. Make sense? My computers, I don't usually do a warranty on them because I'm going to probably replace them every year anyway. I try not to replace my iPhone every year. I'd like to go 4 years, 5 years. Make sense, guys? A contingent liability may only be reasonably possible. For example, a company may have lost a lawsuit for infringing on another company's patent rights. However, the verdict is under appeal and the company's lawyers feel the verdict will be reversed or significantly reduced. We would just report it in the notes to the financial statements. If it's remote, you do nothing. Guys, hey, we could have a hurricane up here. That's remote. Do you get what I'm saying? What's the likelihood of us having a hurricane up here? Not going to happen. When it's remote, we don't do anything. A ski resort may be sued for injuries incurred by skiers. In most cases, the courts have found that a skier accepts the risk of injury when participating in the activity. Thus, unless the ski resort is grossly negligent, the resort will never incur a liability for ski injuries because you sign your life away when you choose to go skiing, right? Okay? So know that for contingencies, if it's probable and we can reasonably estimate it, we're going to record it and disclose the liability. If it's probable and we can't estimate it, we're just going to put a note in the financials. Or if it's possible, we will put a note in the financials. The only time we're going to actually do something if it's probable and we can estimate it. Here's an example. Foster's warranties its products for a year. The estimated product warranty is 2% of sales. Assume that sales were $1,800,000 for January. On February 7th, the customer received warranty repairs requiring $375 of parts and $140 of labor. How would we show that? We would debit product warranty expense for $1,800,000 at 2%, and we credit the liability. Then when warrant parts or repairs need to happen, it's at that time we'll debit our liability and credit our cash. The key being the expense happens when we create the warranty estimate. Okay? General Motors disclosed estimated product warranties. Assume General Motors sales are $127,204 million, and the total paid on warranty claims during the year was $3,249,000. Why are short and long-term estimated warranty liabilities separately disclosed? So in this case, know that the warranty liability represents estimated outstanding automobile warranty claims. Of these, $3,769 is estimated to be due within the next 12 months, where the remainder is later. So we estimate the short-term liability versus the long-term liability of warranties. Next, you're going to have some liquidity ratios, quick ratio, current ratio, some items there. Again, please look at some more of these contingent liabilities shown here. No, most of the liabilities, contingencies we're talking about have to do with warranties. Because things may break down, there's going to need to be a contingent liability on the books. Any questions, guys, before we end? Well, guys, have a wonderful week. Take care. Sure.
So when you were talking earlier in class, the try exam is
The
like,
try.
Oh,
Oh yeah, the last one.
yeah, that's the last one.
Uh-huh.
You said that you're like, is it only for this class? It's gonna be
All
like
of
an
them.
assessment? Okay, all of them.
All
Okay.
of them.
All right, and also for when we don't have class on Thanksgiving, like.
We'll still have work.
And you have my email, right? Like,
Yes.
Because you said you're gonna email everyone like this, or like the homework. or
Yeah,
something?
I won't do that until that week.
Okay, great. I just wanted to
Yeah.
know for sure. All right.
Oh, that's right. You got to remind me. You've got to remind me. You'll have to email me and let me know to send you one too.
Okay.
Because I'll just go in the classroom and do it. Send that to me.
Okay. All right.
Thanks. See ya.
I'll
Yes.
send it to you on the weekend.
Yeah, thank you.
So I'm taking your managerial accounting.
Yeah.
I'm gonna do the in-person one.
Yes.
But so my unit is deploying, and I'm not going because obviously I just got back
Okay.
last year. So they're sending me down to Texas in January as their admin team.
Mm-hmm.
So I'll miss the first week.
Will you make sure you email me and say I'm military, and I will extend it like 2 weeks for you.
Okay.
I'll
I
do
figured
anything.
I'd just bring it up now.
Yeah.
before.
But just remind me because I'm gonna forget.
Okay.
Take care.
Do you mind if I erase the whiteboard?
You can do whatever you want.
Okay.
I think that was from last night.
spelling was supposed to be.
I think it's a business law class.
The red stains. Good dog. Seagrass? Huh? Grading seagrass? Oh. Do that as a little thing. I don't know what it's about. Oh. What's it about?
The native ideology and basic science.
Oh. Yeah, I just forgot my notes in the car for quiz.